Good evening, ladies and gentlemen, and welcome to our class on cryptocurrency. And tonight's class is sponsored by X90, one of the leading platform providers for CFD and Forex trading and stock trading around the globe. And X90 has recently added a full line of cryptocurrencies that you can trade on their platform. Now, they are a regulated provider, and they offer a very broad range of trading, everything from stocks on the Dow, on the S&P, the Nikkei, a large selection of indices to trade, and Forex and commodities. You get a 100% deposit bonus. You get a safe, secure platform. There's no commission, and you get one of the most advanced trading platforms in the market. You can trade CFDs and stocks, Forex, CFDs for indices, oil, and more. You can fund your account with PayPal, Skrill, wire transfer, or major credit cards. You get up to 500 to 1 leverage. All your money is kept safe in Tier 1 European banks, and you know when you trade with X90, you're trading on a safe platform. So before I start our class, I want to go over and show you how you would trade cryptocurrency on their platform. Once you have a demo or a live account, you would log in, and all you do is go over to the left side and select under the asset selector and click on crypto, and it'll show you the current coins that you can trade. You can trade Bitcoin, Ethereum, Bitcoin Cash, Ripple, Litecoin, and Dash on their platform. Those are all being traded against the US dollar. You can see, well, when I took the screenshot, Bitcoin was trading at 40.13, and you could buy it or sell it. So you can go short or long, and you simply locate them on the platform. You choose your instrument you want to buy or sell by clicking on the correct tab. Then you can use their advanced charts to determine what you would think that the asset would doing. You can add indicators. You can set the time frames on the charts. And then all you have to do is, when you click on the buy or sell button, it will open up a screen window for you. It'll tell you exactly how many pips are at risk, what your current risk is, what your margin requirement is, depending on how much you want to trade. You can also tell it to automatically close you at a certain profit level and to protect you at a loss by clicking on close at a loss and what the maximum loss you would accept. And then you can click on to buy your position. You can always see all of your account information right on the left of the screen. And they make it very easy to trade or join the cryptocurrency revolution. Trading CFDs for cryptocurrency is a great way to make profit, because CFDs are simply a contract for difference. You're simply selecting the asset you want to trade, and it is the difference between your opening price and your closing price when you close your trade out. And if it goes in the direction you selected, then the profit is yours. If it goes against you, then you have the loss, but you never own the underlying asset. You only have a contract for the difference in the price from where you started the trade to where you ended the trade. You can keep the trade open as long as you like. And it is a simple way not to be involved with exchanges, not having to buy Bitcoin and put it over in a wallet and understand all these things. You simply trade it on the platform. You can cash it out at any time and have the money transferred right back. You can withdraw your funds right back to your bank account or credit card account. So it's a great way to trade. But first, you have to understand a little bit about cryptocurrency. Now, cryptocurrency is digital currency recorded in a ledger of accounts and transactions between peers using a system of verification and encryption. Transactions are made by sharing public passwords attached to a private and encrypted digital wallet. Each password relates back to a block of transactions on a digital ledger called a blockchain. And this represents a specific amount of digital coins. Well, tell me, did that explain anything to you? Doesn't explain much to me. It sounds very complicated. So let's try it again. Cryptocurrency is essentially a digital ledger of transactions secured by cryptographic codes that act as a decentralized currency, which can be exchanged between peers by sharing public passwords that relate back to your digital wallet. Your digital wallet is like your savings account. It is a safe place to store your digital currency or your real currency in real life. Now, Bitcoin is a digital currency created in 2009 and has become synonymous with all digital currencies. It's become a generic term. Even though Bitcoin is a specific coin, a lot of us refer to the entire industry as Bitcoin. And it's referred to as Bitcoin, and all the other coins are referred to as altcoins. Now, tonight in this class, you'll know the difference when I'm saying Bitcoin as a generic term and I'm saying Bitcoin as a specific coin. Okay? It's like Kleenex and tissue, or Windex and glass cleaner. If I say, hand me the Windex, well, it means hand me the glass cleaner. I don't care what brand I have under my sink. It's the blue stuff in the bottle. You know, tissues and Kleenex, the same thing. Because to be honest with you, saying cryptocurrency over and over again is a real mouthful. So it is a digital currency used to make payments of any value without fees. It runs on the blockchain, a decentralized ledger kept running by miners whose powerful computers crunch transactions and are rewarded in Bitcoins. Cryptocurrency is a form of digital money that is designed to be secure and in many cases anonymous. It is a currency associated with the internet that uses cryptography, the processing of converted legible information into almost uncrackable code to track purchases and transfers. Cryptography was born out of the need to secure communications in the Second World War. It has evolved in the digital era with elements of mathematical theory and computer science to become a way to secure communications. Bitcoin works on what's called a public ledger known as blockchain. And we all hear about blockchain, and the increased demand for the use of this blockchain, which is a way of moving blocks of data around that's fully encrypted and fully safe, has become very popular. This demand for the blockchain has increased the visibility of Bitcoin because blockchain was developed with Bitcoin. Okay. So to create Bitcoins, users must generate blocks on the network. Each block is created cryptographically by harnessing users' computer powers and is then added to a blockchain, letting users earn by keeping the network running. This is not a user like you and me. Buying a Bitcoin doesn't make you a user. These are called miners. These are people that make this blockchain work and do the computations to verify the transactions. You, as a buyer of Bitcoin, just own a digital currency or a digital thing, and the blockchain is what moves that currency into your wallet where you store that currency. And it is the transaction or the movement of that data and the verification of that transaction. So in order to buy Bitcoins, you have to go to an exchange and purchase them using US dollars or fiat currency or euros, and then somebody needs to send you, or the exchange needs to send you that Bitcoin. Because the Bitcoin isn't something like a chunk of gold that you can take and put in your pocket, and it's not a certificate, it's a digital piece of data that says you own something, and it goes into your wallet, or it goes to the exchange, and then from the exchange you can move it to the wallet. But once you buy it in the exchange, it's permanently yours, and it's indelibly etched into this permanent blockchain. Now, even though it's yours, it doesn't have your name on it. It's got this long coded cryptographic password that belongs to you. And wherever your wallet is stored, it goes through this little blockchain. It moves through these little blocks of data that are handled by the miners, and it eventually gets, or very quickly, gets dropped into your digital wallet. Well, this transaction, this piece of data, is shared with every Bitcoin peer on the network. So once it's there, it's indelible, it's permanent. It cannot be taken away, it can't be forged, it can't do anything because it's shared by all the peers on the network. So somebody can't just go in and change and take your money because because it is etched into this permanent ledger that everybody shares. So imagine this wallet that holds your money is like your savings account, and the blockchain is like your bank. Okay, and your bank has a record of all the transactions. Now, it happens to be your bank has your name and address, but it's got your account number. So say the only data out there was your account number, which was added onto a whole bunch more numbers. But the fact is your bank doesn't share its transactions with anybody outside the bank. So if you got all the banks around the world to share and move every transaction piece of data and was shared with every bank, guess what? It would be permanent. That's what a blockchain is. So everybody on the Bitcoin network has access to this data, but this data is all encrypted and with numbers that don't relate back to a person. Now, there is a limit for how many Bitcoins can ever be created in the system. And Bitcoins are created by miners who do work. And these miners get paid a small, tiny percentage of the work. But it takes huge amounts of computer power, CPU power, or hash power, to do these puzzles, because they're the ones verifying the cryptographic keys. And the blockchain breaks down the data into little pieces that are not in one place. They're all over the place. So nobody has all of the pieces of this data all in one fell swoop. It's in the blockchain, but it's broken down so nobody can actually get to it. So each miner or all the miners are rushing to verify the piece of the puzzle so they can add on this piece of blockchain, because that's what they get reward for. It's only the first miner who adds this piece of data into the blockchain who is then verified by all the other miners who gets paid for that work. Okay. Used to be when Bitcoin first started out, they were looking for people to offer their computer services, or that you could sign up your own personal computer, just leave it on, and they would use the CPU power of your computer. Today it's accelerated way past there, and these miners have huge amounts of computer power. And today becoming a miner is very complicated, very involved, very costly. But if you want to become a miner, it's a whole different world out there, and you got to learn all about mining, and you got to become part of the network. And I don't even know how it all gets done, but you'd have to go out and do the research. But just like any other currency, from the US dollar to the money in your PayPal account, currency primarily has value because we all agree it has value. Meanwhile, secondary factors include like a limited supply, a demand for it, use value in the economy that accepts it in terms of exchange value, but there is also work behind it. The same is true for cryptocurrency. It has little inherent use value, with the same being true for a bank credit in a bank account. If you had a credit in your bank account sitting there, it doesn't do you much good. You have to be able to get it out into the economy. So we agree it has value for whatever set of reasons. Thus, it can be traded for other things with value, such as real world goods and services. So once you give something a value, it can be used for things. When it has value, when it has a network, which was you have the miners, and it's got a demand for people who want to use it for things, people need to buy and sell it. When people need to buy and sell something, it's got up and down value. When it's got value going up and down because there's buyers and sellers, there are profit opportunities. So cryptocurrencies use specialized technology to let users make secure payments and store money without the need to use their name or go through a bank. So in order for someone to make a transaction using Bitcoin, the transaction must be submitted to the community. That transaction data includes public passwords that relate back to private ones. So the transaction is both anonymous and encrypted. Once the transaction data is public, community members can collect and verify the data and attempt to crack a very complicated communication puzzle that allows the transaction to be added to the public ledger. Bitcoin mining is an integral part of how Bitcoin works. The Bitcoin network relies on miners to verify and update the public ledger of Bitcoin transactions, to verify that Bitcoin's users aren't going to cheat the system, and to add newly discovered Bitcoins to the money pool. Now, blockchain is the technology that allows for all this. Now, the value to Bitcoin is based on the value of the blockchain or the technology involved. Okay. We see other coins coming off of like Ethereum, which is a fork off of Bitcoin, which means it uses Bitcoin because all you do is write code, and then you have to get through this network. But what Ethereum did is it developed a better, faster blockchain. Same blockchain, but got it to use faster, because if you can get the processing faster and done cheaper with less miners involved. So Ethereum is based on that value of demand, but the underlying value is the technology of how to increase the speed and the efficiency of the blockchain. Now, once you have this payment network in place for any of the coins, once you have a demand for the coins, you have a community built for the coins, you have a safe place to store the coins, we then create buyers and sellers who want to enter the market. This creates profit opportunities. So when I first started taking interest in cryptocurrency, I thought I was so lost in this huge sea of unknowns. Where do I start? What are the available resources? Are my investments safe? Does my coin of interest have a long-term plan? Do they have the means, or have they already worked towards their goals? What are their timelines and their milestones? Does my coin of interest seem like a well-marketed plan with no backup? Lots of ICOs these days have just a pretty web page, and then they're shipped out to sell. Watch out for these. They are unable to deliver. We will discuss ICOs in a little bit towards the end of this webinar. But remember, these cryptocurrencies, because they're not backed on governments, the dollar is based on the economy of the U.S. government and the U.S. government's ability to pay back its debt and function. The euro is based on the Eurozone and then controlled by the central banks. These cryptocurrencies still have to be tied back to something. Even though they're not regulated, not issued by a government, they are tied back to their technology. Their worth is technology. Say, for instance, Uber is worth, what, billions of dollars. Why? Because lots of people use ride sharing? No. It's the technology that Uber has developed that can be applied to all different types of fields and all different types of other categories that makes it so valuable. Okay. And the same thing with the coins. They're all based on this technology. So they're not shares and stock because you don't own any of that, but the demand for that technology that's tied to that coin increases the value or the worth of that coin. So now that you have this network of miners, you have this coin developed, and you have a community or a social network, because until there's somebody who wants to buy a coin, you have no market for it. It's got no value. So I can say I want to issue berry coins, but if I don't have anybody to sell them to and nobody wants to buy them, so I can tell you a berry coin's worth $50. But unless you're going to give me $50 for a berry coin, or you have a demand, or you want berry coins, I'm just going to sit with a whole bunch of berry coins in my computer. So once I have miners and I have exchanges, I need to have a community of people wanting to have these coins. Once there's a community built that we're buying and selling these coins, we create demand. So the most common place where people buy and sell cryptocurrency is on an exchange. Exchanges are places where you may buy and sell your cryptocurrency using fiat currency. In other words, using dollars, euros. There are multiple measures to judge the reliability and quality of exchange, such as liquidity, spreads, fees, purchase price, withdrawal limits, trading volume, security, insurance, and user friendliness. Now, out of all these, I find Coinbase to be one of the best exchanges. But an exchange is important in many ways. Now, when you want to talk about making profit, first of all, this is how you get into the crypto business at all. Okay. You're either going to trade on a platform when you don't own it, like we did with X90, which makes it very, very easy, and then you're just trading on the value and the volatility. Or if you want to go into the real world of actually buying it and real coin, where you go to an exchange, you use your credit card, you put in $5,000 and you buy one Bitcoin. Now, there are many different kinds of exchanges, and there's peer-to-peer, there's liquidity provided, there's all, and then you get that real Bitcoin, you have to move it to your wallet to keep it for safe storage. But when you do that, you can also then use arbitrage. If you can then sit it and hold on it and put it in your wallet and just let it sit there forever. And hopefully over the years, it'll go up in value. Or you can look for ways for making profit. So one of these ways to make profit is through what we call arbitrage, because you can sometimes spot differences in prices between the sell price and the buy price from one exchange to another. Now it gets a little bit more complicated, but sometimes you can find that if you buy the Bitcoin in US dollars, and you might be able to sell it against Japanese yen and sell it to a Japanese exchange. So you buy it over here, you get that one Bitcoin for your US dollars, and you get one Bitcoin, you transfer it to your wallet, and you see you can sell it for more Japanese yen over here, and you arbitrage it. You get in and out, in and out, in and out. A little bit complicated. You have to have a lot of knowledge. But especially during volatile periods of time, you might be able to sell on one exchange and buy at another, because these exchanges don't talk to one another. So this exchange might be selling Bitcoin at 42.05, and maybe both Bitcoin fell, and this exchange over here is selling it at 4,200. You can buy it at that exchange for 4,200 and turn around, move it into your wallet, move it over to the other exchange to sell at the other exchange at the 42.05 and make the difference. This is called arbitraging. Then you also have short-term trading with margin. Once you get familiarized with crypto, you may want to trade on your stash in the hopes of increasing. A lot of exchanges will offer what they call margin trading. For the experienced Forex trader, this is nothing new. But for new crypto investors, you may want to brief up on how to make leverage trading. Short-term trades take advantage of incoming news to make a quick buck. If you foresee good news for an upcoming release of a coin, you may want to open a long position to see how it goes. Now, with arbitraging with an exchange, they might say if you have one Bitcoin, we'll loan you the money to buy up to 2 more Bitcoins. But it is actually a loan. You actually get those Bitcoins, but they loan it to you because they're also holding your Bitcoins, and you have to pay a fee, and you also have to pay interest on the loan. But if you see that Bitcoin is going to go up, and you think it's going to take a hard rise up over the next week, you might want to do this, and then you, instead of having one Bitcoin that goes up, you now have your original plus 2.5 more or 3.5 more. You have to pay back that original debt. But if you got Bitcoin when it was at 3,600 and it went to 42, and you had 3 Bitcoins, 3.5 Bitcoins, you made some nice profit. But there are there are 2 ways to deal with cryptocurrencies. You can buy them in the hopes of selling them at a profit, or you can speculate on their value without owning them through CFD trading, which I showed you earlier on the X90 platform. For Forex and CFD traders who got wind of the hype about phenomenal returns, now they are demanding access to digital assets on their trading platform. Margin trading at cryptocurrency exchanges remains the most popular, but CFD trading is growing by leaps and bounds and will probably by the end of the year way exceed margin trading. So what is margin trading? In a nutshell, margin trading is basically borrowing money from a broker for trading. Most platforms offer leverages of 1-to-1 up to 2.5-to-1, meaning you can borrow 1 up to 2.5 Bitcoins for every 1 Bitcoin deposited. Margin trading allows a trader to open a position with leverage. For example, we open a margin position with 2 times leverage. Our base asset had an increase of 10%. Our position yield 20% because of the 2 times leverage. Margin trading is possible due to the existence of a lending market. Lenders provide loans to traders so they can invest in larger amounts of coins, and the lenders benefit from interest on the loans. In some exchanges, like Poloniex, users provide the loans for the margin makers, and in others exchanges, itself provides them. For example, in Poloniex exchange, anyone can lend their Bitcoins or altcoins and benefit from interest on the loan. The main disadvantage is that the coins need to be in the exchange's wallet, which is a little bit less secure than a remote or a cold wallet. Now, there's also cost and risk of margin trading. The cost of margin positions include paying the interest for the borrowed coins and fees for opening positions in the exchange. As the chance to earn more increases, so does the risk to lose more. The maximum we can lose is the amount we invested in order to open the position. So, for example, if we're talking about a standard trade of leverage of 1-to-1, the liquidation value is when the position reaches a 0 value. Now, for traders with limited amounts of crypto resources, Bitcoin and altcoins, there is an option of margin trading in order to add leverage in their investments. This, in fact, increases the amount invested without actually holding those assets. Important to mention that margin trading is not recommended for everyone, as it is high risk. Now, it is not possible to trade margin on most, it is now possible to trade margin on most exchanges. The advantages of leverage trading are very clear, and almost important advantage is the security aspect. Crypto traders should strive to minimize the amount of coins they hold on exchanges. Exchanges are considered hot targets for hackers, and in recent years there have been several hackings of exchanges. And the last major was Bitfinex hack in 2016, when 1/3 of the exchange's money was stolen. Because this is a target of hackers. Even though the crypto wallets are safe and your crypto transactions are safe, when they're stored in an exchange, it's slightly different because they're stored in an exchange, in a pool of the exchange, and hackers can get into it. When you have, this is the reason to have a remote or a digital wallet, because you take your coins out of your exchange and move it to a wallet that's completely independent of an exchange. And a wallet is simply your savings account, like at a bank. And the hackers can't access enough to make it worthwhile, because they could get in there and access maybe your account, but all that work to get in there and get your 3 crypto coins, you know, they go after things that are worth millions of dollars where they can get in and get lots of money. So trading on margin allows us to open increased positions with no need to provide the Bitcoin required. That way you can hold less coins on your exchange account. For example, if our portfolio consists of 5 Bitcoins, we want to hedge against the risk of Bitcoin's decline. 10 times leverage a short position could be open. So what they're kind of saying here is that if you own 10 Bitcoins, you can leave them over in your wallet and only move the amount you would need to get the leverage of 10. And if you happen to lose it all, you wouldn't actually be losing, you'd be losing money, but you wouldn't be in debt to anybody because your Bitcoins remain stored securely in your wallet. But you still have to cover that loss if you have a loss. If you make a profit, then you did well all the way around. But the most attractive way to trade in the new cryptocurrencies is through crypto trading, is through CFD trading. Crypto trading is like the Forex of cryptocurrencies. This means you are able to trade different Bitcoins and altcoins, normally for US dollars and Bitcoin. Cryptocurrency trading is an alternative way to get involved in the crypto world, because then you don't have to get involved with the exchanges. You don't have to actually buy the currency. You're simply opening an account with a regulated broker. So the money in your account, no matter what, whether you're funding it in pounds, dollars, euros, is in your account and it's under regulation. So it keeps it safe and secure. Uh-oh, guys, something's about to sign me out. So let me wrap this up real fast. So CFD trading with X90 is a great way to get started. It's a nice, easy way that you can start with small amounts of money, trades partial Bitcoins and cryptocurrency, and see if there's a way that you can get into the market. And lastly, we have ICOs, and we're not going to get into them because my computer, for some reason, wants to